Deputy Prime Minister, MD, distinguished guests, thank you for allowing me to speak today, and my thanks to my longtime friend and colleague, Edward Robinson, one of the pillars of monetary stability in Singapore and in Asia, and to Sumit Agrawal and Stephen Davis for, with Edward, their leadership in making the Asian Monetary Policy Forum and AMPF such a success, as well as to Andy Rose and Bernard Young from NUS Business School and so many others. In the period where it was always a good thing to be creating this third pole to go with NBER and CEPR, but it is of course now an even more important exercise. And I look forward to continuing to engage with and support ABFAIR and the Asian Monetary Policy Forum as you provide genuine open dialogue, analytical thought, quality research, and cross-border communication, which we need. With that, let me turn to a slightly more depressing topic. And again, thanks to Edward for his generous introduction. What I want to talk about is the global economy after the peace dividend is gone. A few colleagues came up to me prior to the talk and were saying how, in various ways, I had warned people what was coming. Of course, as the legend has it about Cassandra, the curse is to warn people but be unable to prevent anything. And that's unfortunately where we are. But in the spirit of what Edward just said, citing me on resilience, I do think there are ways forward, and ways forward that are going to be positive. Maybe second best, but positive. I want to talk about the peace dividend in the broadest sense. So not just the amount of money being saved, or no longer being saved as countries spend more on defense, but in the sense that a peaceful world offers dividends. We were able to take for granted a very long time. Not everyone in the world, obviously, but many of us in the billions were fortunate to take for granted a relatively conflictual-free world, and certainly in the economic sphere. And now that is, to some degree, unraveling. And so the question is, how do we think about that and how do we adapt? So despite the fact I will never be accepted as a member of the French macroeconomic mafia, which surrounds us at this event, and I'm sandwiched between Olivier Blanchard and Jean Pisani-Ferry and Nicolas Veron and God knows how many others at the Peterson Institute, I will dare to quote President Emmanuel Macron, who just a couple months ago was saying, no longer will our generation enjoy the peace dividends. It is up to us to ensure that one day our children enjoy the dividends of our efforts. And I started warning about this at Davos over a year ago, that this was a transition that had to be planned for. And so it's, again, we had a world where portfolio allocation and international financial arrangements and even a restrained state role in large parts of economic activity we could take for granted. And as President Macron said in a different language, but here I have the English, clearly we are entering a new era. So I don't do models, I do analogies, so let me give you an analogy. Analogies are like models without the math. The basic problem that the people in Singapore, the people in Europe, the people in various parts of Asia and the rest of the world had is you had a very nice beach house. Say it was in Malibu or Florida or southern Spain, wherever. And not only did you have a nice beach house, but you had very good insurance. Essentially, you were convinced that if something went wrong, the local fire department would come and save you, and if, God forbid, there was a flood or an earthquake or something, the insurance would pay to rebuild. But now, like this house in the picture, global warming is taking place. The foundations of the house are more at risk, and the police department and the fire department are not as dependable as they once were. So ideally, in a world of perfect contracts and everything else, if the world's a riskier place, you might be able to pay for more coverage or to compensate for the risk. And I know we have financial geniuses in the room who could cost that for us. But instead, to put it bluntly, you're having now to pay for insurance against your insurer. That the Trump administration, and to a lesser degree, but an ongoing degree, the Chinese Communist Party, are using the definition of insurance that was the stuff of mafia movies in the US. You have a very nice house here. It would be a shame if anything were to happen to it. You should pay some insurance to make sure nothing happens to your house. I say that jokingly, but it's very real. And so you now do not have insurance, and the risks are going up. Global warming is a risk, but also the analog of geopolitical risk is going up. And while people, including our mutual friend Marcus Brunnermeier and others, and some of the people like Alain and Pierre-Olivier in this room, have written about the shortage of safe assets, I think one way to think about this is not only do we have insufficient issuance of safe assets, but things that were previously safe are now eroded in quality, or less safe than they once were. And so, given that, if that's essentially the underlying problem, how should we think about things? So, as Edward said, I try to bridge the practical. So let me talk about some few themes that I think are the state of the world economy going forward for the next several years. I'm picking 2028 not because I have faith that this will all be over. If anything, I don't think so. But just to say this is a little beyond, these are meant to be trends that are a little beyond the quick business cycle. The first thing to recognize is that the change in US trade policy and practice is fundamental, meaning that this is a change in the use of rule of law, an undermining of the institutions, particularly domestically. And so I would make another analogy that to Brexit, that there is ongoing uncertainty now built in. As some of you know, I was pretty active in the public debate over Brexit. I was against. But I got into repeated disagreements with people who are both for and against Brexit, who would say, the problem with Brexit is the uncertainty. We don't know if it's going to be hard or soft Brexit. We don't know if it's going to be Boris Johnson or Theresa May negotiating. We don't know what the deal with the EU is. And I kept saying, the problem with Brexit is an uncertainty about Brexit. The problem with Brexit is Brexit. That you're moving to a fundamentally different regime, which is inferior. And as many of you are familiar, and I'll put up the chart in a little bit, what you see is, and Steve Davis, among others, knows what this well, you get these measures of uncertainty that go up with Brexit and stay up. And you get measures of corporate investment in the UK that go down and stay down or plateau. And unfortunately, though this is not Brexit for the US, I think we have to think about it that way. And the second point I would make, and this relates to an article I published in Foreign Affairs this fall, is that the particular strategy, I hate using that word in this case, maybe I should say strategery, of the Trump administration in these matters is deliberately to foment uncertainty. They have self-described it this way. Secretary Bessent has referred to this in the run-up to the talks with Chinese counterparts in Geneva. And this goes back to something President Nixon, who seems to be their role model, that is not a joke. Explicitly, their role model is he had what he called the madman theory of foreign policy, that if you raise the prospect that you would do something bad or crazy, the other side has to take that into account and will be more yielding. And what I argued in the fall, and what seems to be happening, is that this may or may not work in national security environments. When you're threatening with nuclear weapons, it is a way of saying, no, I really don't want that to happen. But also, it's very clearly a bilateral negotiation between states. When you start using the madman theory in economic affairs, you are much more ineffective because you are not simply negotiating with states. You're, of course, dealing with millions of decision makers making billions of decisions who will take measures of resilience, of self-insurance, of whatever. And so this backfires. Nonetheless, despite the foolishness and destructiveness of the policy, this is where we are. And so at a macro level, which is what the people in this room are having to confront or think about, I think we're in for a period of rising inflation, of extended fiscal expansion, of higher interest rates, and eventually, maybe not too far from now, increased financial repression. Some of this was inevitable and cannot be attributed to the Trump administration, or maybe not inevitable, but was deeper caused. There was no question we were moving to a world where Europe and Asia, and the US for that matter, all had to engage in more defense spending and ideally engage in more spending on green technology and infrastructure. And in a joint conference we held 2 years ago with the IMF, as I gestured towards Pierre Olivier, we talked about this issue, and that would, in the absence of anything else, still drive up our star and put you in this kind of world, and would potentially, in a political economy way, put you at more risk for inflation. But nonetheless, things are worse. But the other thing I want to say is just to emphasize that, as we're seeing now with the attacks on Harvard and other higher education institutions in the US, that we're seeing disruption of business networks, human networks, flows of technology, flows of ideas, flows of people, and that these ultimately are more important in a lot of ways than straight up goods trade. And this will be where the productivity losses will be really felt. I think another point that especially this audience needs to consider, and something I've been warning about for a couple of years now, is again from a political economy point of view, there has been a tiering, a separation of the largest, most geopolitically significant emerging markets from the rest of the developing world and the rest of low and middle income economies. We saw this in the Fed tightening cycle over 2020 to 2022, where Brazil and Indonesia and India and Mexico and Turkey, once they stopped shooting themselves in various body parts, metaphorically, had more room for policy adjustment and much less broken crockery financially than in any past tightening cycle in the post-war period, let alone a cycle in which you were moving 550 basis points. Now, again, there are many factors involving that, learning since the financial crisis, many other things, but I want to stress it is not an accident that it is the largest, most geopolitically significant, essentially the G20 EM, who have done this. And as the IMF and the World Bank and others in the Asian Development Bank have pointed out, the rest of the developing world is lost many of the gains they had prior to COVID, is in severe ongoing debt trouble. This is not going away. And then I also want to stress, and I'll come back to this, that we're in a period, and I assume LN will talk about this in a very different way, but maybe to the same effect, where there is a step down in the centrality of the dollar underway. And I'm choosing those words carefully. Step down, this isn't an ongoing chaotic exit from the dollar. And centrality, this isn't, as Barry Eichengreen and many others have taught us, this isn't about yes, no, there's one reserve currency. This is about how much overweight the dollar is in various functions that the BIS and others talk about. And so, two other risks, which I think are not sufficiently appreciated and are beyond the remit of central banks, but which have to be considered, are first that the US is removing itself directly as a government, but also effectively downgrading the ability of its companies to participate in standard setting. And standard setting of technical standards, laws, informal and formal institutions. And this creates potentially a vacuum. Does China move in and get control? Does Europe stand up? Does ASEAN stand up? That remains to be played for. But just to say that this is a part of the situation that will have profound consequences that I think needs to be addressed. And the flip side of this is I worry a great deal about the US becoming a green Galapagos or an anti-green Galapagos. What does that mean? Particularly in East Asia, some of you will remember 10 or 15 years ago, there was talk about, maybe even 20, I'm getting old, there was talk about the Galapagosization of Japan. The idea that Japan was developing various technologies that were solely for the domestic market and was diverging in important structures and ways from the rest of the world. If, as has some popular support in the US pursues a very different pace of decarbonization and accordingly emphasizes technologies that are very different than, say, what becomes the primary technologies in a world where more countries are adopting green standards, potentially the US is, or the North American market or people aligned to the US are in a different space. I haven't fully thought through the implications of this, but I think it's worth your considering. Now let me pick up the pace, and those are the main themes, and then try to get through some of it. So what came out, this is based on work by my colleagues, notably Chad Bown and Mary Lovely, among others at the Peterson Institute. What did we learn from Trump's first trade war? The US was able to reduce direct reliance on China, but first it was the easy things that you could substitute, as you would expect. That's the first things to change. And second, that it came from, as very obvious, the movement of production to places like Vietnam, Thailand, and so on. And while this happened, in part because of this, both ASEAN and the EU substantially increased their direct reliance on China. The amount of inputs, the amount of FDI linkages, the amount of trade, including in intermediate goods, has grown enormously. And so in a world where there are beneficial aspects to economic integration, to understate it, the first Trump trade war did not lead to a global decoupling and did not even lead to a full US decoupling. But what was different the first time under Trump, and even with the Biden team effectively, passively leaving this in place, was that most private actors and governments hoped this was temporary and reversible. And I think the recognition now is that's not the case. And so just to illustrate this, the black line is the general trend of US imports, and the orange line is the share that comes from China, or excuse me, the level that comes from China basing to 100 in June 2018. And what you see is in line with what I've described. The share of imports from China has gone down for the US. And China shifted to new markets. Again, all the data for this analysis is available on the Peterson Institute website. So then you have to ask yourself, what are the goals of the Trump administration with this policy regime? And a number of people, including my colleague Maury Obstfeld, have done a wonderful job of pointing out the economic contradictions of some of these goals. But let's just appreciate there are multiple goals here. They want to tell people in the US, we hear your grievances and we're doing something about it. They want to restore US dominance, particularly in manufacturing employment. That's the key word, employment, not necessarily in sales or even technology. If it was in technology, US, they would be happy. This is about employment. Third, they want to worry about bilateral trade balances. For this audience, I don't need to belabor why that's stupid, but anyway, they do. They want to restructure international trade relations so that the US is not, in their view, being taken advantage of, but instead is taking advantage of others. They want to raise federal revenues to pay for corporate tax cuts. They want to leverage the US market to get non-economic concessions from various countries, and this is true to Singapore, this is true to Germany, this is particularly true to Korea and Japan. And arguably, and this is something that's coming out more clearly now, they have a foreign policy motivation of they want to create a commonwealth, and I know that's a trademarked British word, but they use this term probably because Neil Ferguson is the pseudo-intellectual behind it. They want to create a commonwealth of like-minded countries aligned with the US, which would be, of course, Northern Europe, Canada, Australia, possibly Singapore, Korea, Japan, Taiwan, possibly Israel, and in some permutations, the Abraham of the Gulf. So where do US tariffs end up? If some of you have been subjected to my talking before, if you had heard me speak in December or January, as I did at the Bellagio Group or other places, where I told you the US trade policy was going to end up is roughly where we are now. 10% across the board tariffs, 4 key sectors: auto and auto parts, semiconductors and related industries, pharmaceuticals, steel and aluminum by Galaxy A15. Sorry, I'm seeing things you're not. That's good. So you're going to have these 4 major sectoral tariffs. You're going to have across-the-board 10% tariffs. You're going to have punitive tariffs on China. You're going to have demonstrative tariffs on Canada and Mexico to demonstrate that even a trade agreement Trump made by himself would not be used, would not be respected. And that's where we've ended up. And so, again, as with Brexit, don't get caught up in, do they have a deal with this country or that country? Obviously, if you're working for the Singaporean government, you have to go through the motions and try to deal with it. But that's not the point. This is to the Trump people in equilibrium. It may not be an equilibrium you like. It may have a lot of fuss and uncertainty, but to them, this is the end result they basically wanted. What do they want from China? I'm not going to belabor this. There's a James Bond reference here for those who get it. But the main point, and this was true of the Biden administration as well, that the insistence is essentially, no, Mr. Bond, I don't want you to talk, I want you to die. That the problem in dealing with China is that the US government, and this was true under the Biden administration, although slightly more nicely put, but not by much, is there is no off-ramp. We are just trying to decouple from China and possibly harm the Chinese economy. We are not setting out a list of specific things that you can fulfill to reduce tariffs. And this is, of course, ultimately why Europe, ASEAN countries, Singapore included, and others will not line up with the US because that is not a tenable position. So again, some of these charts, the US, if you look at the red bars in the middle, has massively shrunk its direct imports from China. The EU has massively expanded. This is work done by Albert Park and colleagues at the Asian Development Bank on the expansion of global value chains to Southeast Asia. But the key thing Trump too is doing is they're very concerned about leakage. The idea that Chinese goods coming in from Mexico or Vietnam are a way of getting around tariffs. And the Biden administration also expressed this. So that's one of the reasons you should think about this as an ongoing issue. And if you end up keeping these kinds of tariffs on all these other countries and you start putting in very extreme rules of origin, then this system doesn't work very well. As my colleague Martin Shor-Zempa at Peterson has documented, and as people like at the GIC or Temasek or other sovereign wealth funds in the world are dealing with, there's a lot of restrictions on FDI into the US, on acquisitions by Chinese companies, but also on foreign countries in general. And there are a lot of countries that are being extremely strongly encouraged by the US to put in restrictions on inward FDI. And this is one way of measuring it. This is another. Amidst all this, Europe has continued to increase its reliance on Chinese technology, despite the famous event of Huawei. So ultimately, as I made reference, the problem with the trade war isn't uncertainty about the war, it's the war itself. So like Brexit, where uncertainty goes up, comes down, but only comes down to twice what it was on this measure, what it was before Brexit, and investment basically remains flat or at a much slower rate of growth. This is the kind of thing we should be expecting for the US big picture. Don't get caught up in the tactics and the details. But I would suggest, now bridging into what's relevant for central bankers, and I realize I've already burnt a lot of time, is that part of this is you start recreating COVID-like supply chain disruptions. And it's not going to be on the scale of COVID, obviously, but they're meaningful. And just to give two examples from the US right now, one is housing. Again, stuff some of you know and some of you don't. The residential housing market in the US, particularly single-family homes, small apartment buildings, multifamily dwellings that are not large apartment buildings, are built by tens of thousands of very small companies. These very small companies, 50% of their workforce is migrant workers. They import huge amounts of lumber from Canada, which is tariffed. They import huge amounts of air conditioning and other equipment from China, which is tariffed. And now, the same time, the president wants to privatize Fannie and Freddie, what are called the agencies, which would further make more expensive housing finance. So in a macro sense, in the outlook, I think people are underestimating the chance of a residential construction supply shock in the US. But in a macro sense, this is an example of the kinds of things that you have as unintended consequences when you go down this road. Similarly, DOGE, about government budget cuts. What you're worried about with DOGE is not that they're actually cutting USAID or the Department of Education. Well, some of us do worry about that. But from a macroeconomic perspective, if they were just cutting those agencies, if they just put out a budget and said, we're zeroing those agencies, again, I think it would be a bad idea, but fine. But what has happened instead is they've created a miasma of uncertainty over the entire federal civil service of the US. And they're losing a huge cadre of senior civil servants. And even more economically significant, they have messed up contracting with specialized government private sector entities to provide government services. And so this is another example. You break down rule of law, you do budgets by arbitrary rules rather than by strict budget processes. And of course, no one in this room would ever do that in their country. But in the US, we're doing that. And so again, my point is first just to tell you that top line, don't underestimate the recession risks in the US being compounded by these two channels. Medium term, realize that these are the kinds of supply shortages and shocks you get in this kind of environment. And so we have a very drastic reduction in migration, even if deportations have been much lower than they said. We've essentially gone to a zero annualized net rate of migration in the US. I'll skip over insulting Europe for the moment. For the monetary audience, my main point, again, talking about general and specific. I think at the 2-year horizon, people are underestimating the inflation risks. As we all know, if you put tariffs into a standard macro model, you just don't get very big effects. But I think they were taking place in a world where the anchoring of long-term expectations in inflation in the US is weaker than it was in 2020, where the Fed, for political economy and judgment reasons, is going to be behind the curve, and where critically, in contrast to something Edward was saying, and which a lot of us are talking about, and Ellen and others will explain in better terms, we have a reversal of the standard dynamic that with tariffs you have an appreciating currency, and that the US generally, even when it messes up, there's flight to safety into the dollar, that treasuries and currency move in opposite as opposed to similar directions. And again, I would suggest this is a change in regime. This is the house on the beach getting undermined. I won't go into so much detail, but I argued in 2008, and then Barry Eichengreen and co-authors made it more econometrically sophisticated a few years after that, that the missing mass explaining the dominance of the dollar wasn't totally economic, it was in part the security relationships. that alliances and force majeure were part of the reason you aligned us. In some ways you can see this. For example, why was anybody in Africa on the euro? It was because they used to be on the CFA franc zone. Why were on the CFA franc zone? They were on the CFA franc zone because French troops were throughout Western Africa and alliances were there. I'm just using that as a very crisp example. My paper from 2000 goes through many other examples, and again, Eich & Green just republished in CPR a reminder of their work about this. The point is, the reason co-movements in the treasury and currency markets don't prove anything, but they are consistent with this being a step change. If you didn't see that, it would be hard to argue this is a step change. Seeing that is not sufficient, but it's close to necessary. And so what I argued was that the euro was not going to be able to supplant the dollar as long as it had such a low security profile. And again, Eich & Green, Mayo, and Chitu talked about this. But so if we're reversing that, as my colleague Jacob Kierkegaard, among others, has been tracking, and Europe is massively increasing its ongoing defense spending, and countries in Southeastern Europe, notably in Ukraine, possibly in the Med, are going to be looking to a new insurer, currency will move with that, currency usage. So there are a number of things in my slides where I talk about things that you should be watching for a step down in dollar centrality. And this includes a blend of economic financial factors and foreign policy factors. The key things I would flag is there have been a series of speeches over the last 2 months, starting with President Lagarde, also Philip Lane, also Klaas Knot, another one the other day, from ECB governing council members talking about how having a digital central bank digital currency for the euro is an important step to free the payment system from the arbitrary sanctions and use and increase sovereignty. This is very different than when John Pisani-Ferry and I were looking at the global role of the euro 15 years ago. This is a very direct, deliberate change. I think it is a rational behavior, just as changes are going on in terms of dependence on military spending on US weapon systems. But it is a change in the system that will matter. And here in Asia, I'm starting to have conversations, I won't name who, but with central banks and finance ministries about revival of terms that we thought were gone 15 or 20 years ago, the Asian Monetary Fund, the Chiang Mai Initiative, and various other things. These are all forms of self-insurance in the absence of a good insurer from the US. So I think we have a changed macroeconomic and financial landscape. I think long-term real rates are going to be higher. I think there are going to be divisions in the flow of interfering with the flow of savings from China and surplus Asia into Europe and particularly into the US. And that potentially raises interest rates in the dollar zone and decreases interest rates and is potentially disinflationary in China, or if not deflationary. I think there are a lot of other things going on, and the risk of nationalism in investment and financial repression. That is, of course, historically what happens when you move into a national security dominated era, is you're spending more and the government feels more comfortable pressuring markets and pressuring the central bank to make sure bond issuance gets taken up. Let me conclude, and I know this is 1 minute over, so let me conclude. Implications for monetary policymakers. So the first point I would make is don't just think about greater volatility, think about blockages. I understand that's not the way anybody's thought, and the idea was capital always gets through, but in a world of increased conflict and national security, there are ways of interfering with the smooth flow of capital that will not easily be arbitraged. And importantly for developing Asia, remittances will be disrupted because of national security and because of migration interference. And this is going to affect capital flows as well. Second, that the growth picture is going to move, and ASEAN, which will have currency inflows and issues coming from this, will be seen as a source of growth when other parts of the world that have been counted on as sources of growth will be less so. Third, despite the Supreme Court, as you may have heard overnight in the US, affirming central bank independence, thank goodness, They didn't affirm independence of other government agencies. They said specifically the Fed. I think we have to look historically. My first publications 30 years ago, which were first presented in Singapore, was about how central bank independence isn't something you just declare. It depends on the availability of political coalitions to support it. This is an environment where for the US and some other countries, that's not going to be the case. Fourth, perhaps most controversially, I know a number of brilliant people, starting with Ben Bernanke and others, have talked about scenario planning as the key new innovation, the new change to the inflation targeting framework to help us cope with all this. That's not, to me, going to save us. The main issue is going to be this, as Edward talked about, the discerning what's a supply shock versus demand shock, what is the balance, what is the factors that lead to persistence of the inflationary aspects of supply shocks. And you can call it scenario planning, but it's actually getting into the weeds in a very different way than central banks normally like to do. And finally, I think alternative assets, most of which are scams, but anyway, alternative assets and central bank digital currencies, which as others have acknowledged, finally has a reason to exist, are going to be coming into more active competition, and this will cause some challenges, particularly for developing country central banks, but even for small open economy central banks like those of the Monetary Authority of Singapore. Here are some references, none of which you've ever read, and let me end it there. Thank you very much.